Stephanie Link is still with us, head of global equities research at Nuveen, and she is joined by Jack Manley, global market strategist at JP Morgan Asset Management. But Mike, we're going to give you the first comment as usual. The S&P did close above 3,200. Is that a significant psychological mark?
I think the round numbers, I don't think 3,200 necessarily was considered to be a very stiff test. I think a lot of the patterns that have formed on this rally since October, folks have been looking for whatever reason for targets about 1% up from here, so 3,230. It just basically is a count from, the magnitude of the decline and then the recovery. But I do think it sort of shows you in the absence of news, which really there was not much relevant news that could have been driving the market up by 0.5% today. You just had the seasonal tailwind along with the industry would call it equitizing cash, basically making sure you put cash in the market, not to be left behind. It works until it doesn't. I think the question is right now, is the bull case just too overbelieved in the short term, or are people going to get too upbeat going into next year? Maybe, but right now the trend is pretty strong.
I mean, but Mike, just to the point though, the shape of the move today, rally into the close, which is encouraging. Volume's not too bad. VIX down again a little bit.
Yeah, I mean, everything is lining up in the proper way. I just think the question is how much is too much, and you haven't had a sizable pullback in some weeks right now, and I do think that's just one of those things you have to be aware of. Not to say you change your strategy, but you say it should not surprise me right now if some random thing comes along and knocks it off course for a little while.
Jack, it feels like we're at a very different spot this December than we were last December. A lot of our fears have been subsided, whether it's in Washington, D.C. or otherwise. Do you think we're being a bit too complacent?
I think what's most important to remember here is while we've seen some good news coming out in terms of trade negotiations last week, in terms of the UK parliamentary elections last week, we're not out of the woods just yet here. I think it is safe to say that the worst is probably behind us, but these are one steps in a large multi-step process. There's a whole lot more to do out there, and I do think that markets are at a risk of becoming a little too optimistic.
Steph, how optimistic are you for next year if we don't get the earnings growth that the market's expecting? Would that lead to a much bigger swing than perhaps typically?
Yeah, we totally will stall out. Whether we go down, I'm not so sure. I just want to just focus on what happened today for half a minute. It's interesting. Today was much more of a defensive feel, much more of a growth feel versus the cyclicals, which have actually been leading for the last 2 months. And it's just noteworthy, right? Because Mike said there wasn't a lot of news out there, and all of a sudden people are kind of they're basically cashing their chips in the things that have been working. And so it's going to be interesting to me into the end of the year if this rotation continues.
Mike, 2 days now of Apple underperformance relative to the other big tech stocks, but still 2 days of slight gains. Kind of sums up that kind of positive grind higher with no other news out there.
Without a doubt, it's a positive grind. It's you sort of buy the marquee names. Most of them are participating. I mean, at 280. Apple doesn't owe you anything at this point in the short term. So it's certainly probably a positive. It's sort of hanging in there. But again, I do think you want to get into a period where there's a little more back and forth action as opposed to just this kind of upside air pocket in a very strong pre-holiday tape.
And Apple kind of traded with the value group, right? So
it did,
you can see why it also is lagging today as well.
It's the largest stock in the S&P value.
Treasury Secretary Steven Mnuchin appeared on CNBC earlier today, giving new details about the Phase 1 trade deal with China.
I'm very confident. So it's just going through what I would consider to be a technical legal scrub, and we'll be releasing the document and signing it in the beginning of January.
Jack, to your point about global risks falling a little bit out there, how important is this one getting over the line in January with some ink on the paper?
I mean, the timing in particular, I don't think is extraordinarily important, but I think this is really good news because for the first time in a long time, we're actually seeing concrete evidence of progress being made. I mean, I think we have to remember this is a Phase 1 deal, which means there are other phases that are going to be coming alongside it. But what's important here is that it sets the tone for next year, which is to say that positive outcomes are possible and perhaps even probable. And one of the biggest risks on the table, I think, has now been greatly diminished.
Jack, as a global market strategist, as you look into 2020, would you be looking at other markets beyond the U.S. that have sort of underperformed over this last year? Or is U.S. and equities here really the best place to put your money in a portfolio?
I think what we can expect to see next year is some strong performance out of international markets because the worst is probably behind us. We're starting to see perhaps evidence of manufacturing activity turning around, although most recent numbers were not particularly supportive. Brexit-related news last week was encouraging. This trade deal is encouraging. But I think at the end of the day, as long as all of this uncertainty persists, and again, I don't think it's really going to be going anywhere anytime soon, international markets will underperform relative to the U.S. So while next year may be a better year for international investing, I still don't think it's going to be a 2017 type year, and investors should still probably focus mostly right here in the U.S.
Mike, is January now shaping up to be quite tough for equities, sort of more room for disappointment than positive surprise?
Or at least a lot of maybe whipsawing. I mean, it is a month where you typically see the reversal, at least in the short term, of what has been working. You kind of sell winners to buy losers. It's the source of the so-called January effect, where you supposedly have beaten down small stocks that do recover, and then stocks that have won, and people are just waiting to sell them because of getting it into a new tax year. Yes, I do think it does set up that way. Now, that being said, I don't really believe in the whole we're borrowing future returns. It's kind of not the way the market works. The market trends in certain directions. I think the trend is still positive. The next sell-off is probably not going to be the big one. But again, I do agree with Jack that positive outcomes are possible, but when negative outcomes are right in front of everybody's face, people say you have to look through them. You have to be aware that those are the times to buy. So when everyone is agreed that positive is what's in front of us, it's not always, clear sailing.